All right, let's pop the hood on Penske Automotive Group. They're a huge, huge player in the global auto market. And their latest earnings report? Well, it's kind of like a roadmap, showing us exactly how they're trying to navigate a pretty complicated economy. So, what is really going on with this automotive giant? And that really gets to the core question here, doesn't it? When the economy starts hitting some bumps in the road, how does a massive global car dealer like Penske actually hold up? We're going to dig into their latest quarterly results to see what the numbers are truly telling us. Okay, so if we take a first glance at the dashboard, the main numbers for the fourth quarter, they definitely seem to be flashing a few warning lights. Yeah, you don't need a magnifying glass to see this. The year-over-year comparison is pretty stark. Revenue dropped from $8.1 billion down to $7.8 billion. And net income, the actual profit, that took an even bigger hit. This right here is the storm cloud that seems to be hanging over the whole report. But here's the thing, and any good mechanic will tell you this, the dashboard doesn't always show you what's really happening with the engine. And when we look under the hood at Penske's operations, a totally different and honestly a much more powerful story starts to emerge. And it all really boils down to this one number, 5%. That's the revenue growth they saw from their existing service and parts locations. You see, car sales can go up and down like a roller coaster, but this part of the business, it's the company's reliable workhorse, just consistently chugging along and pulling ahead. And we're not just talking about a little growth. This was a record-breaking performance. I mean, let that sink in for a second. In a quarter where the big headline sales numbers were down, their service base and parts counters were more profitable than they have ever been. And it kind of makes sense, doesn't it? When things get a little uncertain, people tend to hold onto their cars longer, and that just means more repairs, more maintenance. This right here is the resilient, beating heart of the entire company. Okay, check out this chart because it tells you almost everything you need to know about Penske's business model. Just look at that huge slice for service and parts. See? While selling new and used cars brings in a lot of revenue, this one division generates nearly half of the company's gross profit. That's the real money they make after all the direct costs are paid. It's not just another piece of the pie, it's the profit engine. So the logical question is, if the service division is so incredibly strong, what on earth caused that dip in the main numbers? Well, the company was actually very clear about the external pressures, all the road bumps they were hitting. And here you've got the company's chair, Roger Penske himself, acknowledging that tough environment head on. He's essentially framing the results not as a failure, but as a really strong performance given the tough circumstances. He's highlighting just how resilient their overall business model is. And here are those specific headwinds they were dealing with. First off, a real slowdown in the commercial trucking world. Then you've got economic weakness over in the UK, which is a big market for them. Third, kind of a weird one, past sales incentives made this quarter's numbers look weaker by comparison. And finally, a supplier had a cyber attack that messed with inventory for some key luxury brands. It was like a perfect storm of factors all hitting at once. But here's the key. Penske isn't just sitting there and bracing for impact. No way. They are actively steering through these headwinds, giving the whole company a major strategic tune-up to get ready for the road ahead. And this slide right here, this shows you that strategy in action. On one hand, they're selling off 23 smaller, less strategic dealerships. But on the other hand, they're taking that cash and buying up much larger, high-performing Toyota and Lexus spots. Essentially, they are trading up in a massive way. Think about it. They're swapping out $700 million in revenue for an estimated $2 billion in new annual revenue. That's a huge strategic pivot. So strategy is great, but at the end of the day, for any public company, the final destination is creating value for its shareholders. So let's see how all this confidence and all these strategic moves are actually translating into real returns for investors. First up, the dividend. The company boosted its quarterly payout to $1.40 per share. Now, that might seem like a small detail, but here's why it's a huge deal. This is the 21st time in a row they've increased it. That is a powerful, powerful signal from management that they are very confident about the future. And they didn't stop there. The company also went out and bought back nearly 1.2 million of its own shares. This is another really direct way to boost value for shareholders. By taking shares off the market, you make the ones that are left more scarce and, in theory, more valuable. So, when you put it all together, you've got this really fascinating picture of Penske right now. On one side, you've got slowing sales and some serious market headwinds. But on the other, you have this incredibly powerful profit engine in service and parts, a really smart strategic shift, and strong, confident returns to shareholders. It all leads to the big question, right? Is this diversified model they've built truly made to win the long race, no matter how many bumps are in the road? That's definitely the story to watch.